Welcome to the Just Word Podcast. I'm Pat Bolland. The Just Word Podcast is brought to you by Justwealth, investing the way it should be, just for you. Francis, welcome to 2023.
And let's hope it's a better year than 2022.
Okay, let's get that out of the way. What was your overall impression of 2022? Because as I pointed out, it was not a good year for a lot of investors.
We started actually 2022, you and I doing the same thing. And I went back and listened in. And of course, stock markets and economic forecasting is always a humbling business. And I wasn't over the top bullish at the beginning of last year, but I missed a lot for sure. It was a tough year. I mean, aggravated for sure by two big things. One, the Russian invasion of Ukraine. I'm sure there were people who saw that coming. They'd seen it coming since 2014, but I don't think anybody thought it was going to happen in February of 2022. And the second thing was the extensive shutdown of China for COVID, which kind of aggravated the Ukraine situation, supply chains and everything that we were talking about in 2022 early on. I expected them to be relieved sooner than they were, but maybe that relief got obfuscated by Ukraine and China shut down and just the way markets swing, because they do get all verklempt about something and they take it to the extreme. So last year saw a lot of extremes for sure.
Okay, but you did get some things right, and we did talk about them. For instance, we did talk about the shift out of technology. What we didn't talk about was the hard sell-off we saw in the tech sector. Why do you think that happened?
Two reasons, probably many reasons, but one was, which I probably got right, I mean, they're just ridiculously overvalued. I mean, metrics that were being used at the beginning of 2022, following on from 2021, were price to revenue, even enterprise value to nothing, because there was no EBITDA. I mean, there was crazy valuation, and the momentum from 2021 had taken everybody into 2022 with a lot of enthusiasm. So I think that was the one big item when we just swung too far in valuation. The second item was probably as well that I don't think a lot of people, and certainly I didn't, got a sense of all of that overspending in the technology space, whether double ordering in semiconductors, over hiring in some cases to account for what had happened in 2020 and early 2021. But so we kind of missed sort of the nuts and bolts of the business. Earnings expectations had already started to come down at the beginning of 2022, but they just did not come down enough.
But everybody was starting to work from home because of the pandemic back in 2020. Everybody was working from home, and all those tech companies were valuable. Did they draw forward their sales? I mean, did they cannibalize their future sales to a degree too?
I think that's absolutely bang on. I mean, it's something like a DocuSign, which I think about in the brokerage industry in particular. In 2019, you could never sign anything, opening an account or asking for a check to be distributed or whatever it was, without actually being in the office. March, April of 2020, it just went like everybody does everything online. But, incrementally, how many more people are around to do things online? Now, some would argue with the DocuSign, I'll just keep that example, which went from nothing to everything. Now they have this base of clients that are sticky, very sticky. People aren't going back. And there's the opportunity to leverage off of that sticky customer profile. But, that's going to take a couple of years before that really flows through to the bottom line.
Yeah, no question. And you touched on Ukraine a little bit, but geopolitics in general, it seemed to me that geopolitics took a backseat for the last couple of decades, whether it was the growth of China, well, and the growth of China, people kind of did invest in that. But, Trump politics and all the other things that were going on, and the market did its own thing. Ukraine definitely upset the apple cart, didn't it?
It did, I think, because it wasn't just uh, Ukraine. It was because of what it did to the rest of Europe in terms of cutting off supply of energy. And we're only lucky to some extent this winter that in Europe in particular, the weather has been relatively mild. So it hasn't turned out to be the devastation, shivering in the dark that it might have been.
Mm.
And NATO banded together and all kinds of things. So it was a factor of, it wasn't just some, country invading another country. That's happening all the time, sadly. But it was Russia, and they kind of held a wild card in terms of their energy control of both the production of energy and the delivery of it. So I think that aggravated the situation. And now it's been almost 11 months. The devastation is just, everyone just shakes their head. And it's very hard to see what the out will be because, and I'm not any, the big joke was in 2020 and 2021, everybody was epidemiologist. And of course, when Russia invaded Ukraine, they're all, defense authorities or politicians. I don't have that extensive knowledge, but sure does look like it's going to be hard to see how it ends.
Well, let's bring it back to finances, though, because one thing you haven't mentioned for 2022 is inflation. And we touched on it at the beginning of the year in terms of creeping wages and energy issues you've talked about already, supply chain you've talked about. But I mean, I don't think very many people saw the huge jumps in inflation and the knock-on effect as far as interest rates are concerned, did they?
No, even when we were discussing all of this in 2022, I did see that inflation would rise. I did see the Fed raising rates, but I think I said very specifically that I might see 2% or maybe 3%. And I'm probably ad-libbing there, but I said definitely I didn't see 5 on Fed funds, and we're within spitting distance of that, and we will be 5 this quarter. I think the interesting thing about inflation is that, and I like to say this generally about economists, is that we are using the same tools that we used for decades in making our projections going forward. And quite honestly, the last 2.5 years are nothing we've really seen before. Now, some say it may have been like 19, 18, 19, but we've not seen this kind of crazy spikiness in inflation. But more importantly, we've not seen the Fed act as quickly and as dramatically as they have. And I think they had egg on their face, like a lot of people who use the term transitory. But more importantly, inflation really peaked like in the first 5 months of last year. I mean, if you look at any of the parts of US CPI, and probably to some extent Canadian CPI, they've all rolled over. I mean, there are a lot of negative signs in the last US CPI report. As wages have trended down, food prices have trended down, still very high. For sure. Energy prices have come down dramatically. So, we're maybe, and people I know who are very smart are talking, disinflation, maybe deflation as we go forward, especially because your comps, you've got that base effect. And in 2022, the base effect was negative for inflation. In 2023, the base effect actually could be pretty positive for inflation.
So am I hearing that you're thinking interest rates might come back down?
Well, a couple of things. Never to zero. I mean, never's a long time, but I don't see zero. And I do see a pause probably in maybe March, April. Do they come down? I think they're going to stay higher for longer now, just because the Fed doesn't want to do anything. They don't want to be a repeat of the early 1970s where we saw rates go up and then they came down and inflation spiked again. So down, I don't think so, but I could live, I think we could live with 4 or 5% Fed funds rate. And at the same time, they are reducing liquidity in the system. They are rolling off their balance sheet. Canada is rolling off its balance sheet. The Central Bank of Europe, the ECB, is rolling off their balance sheet. So there's a lot of liquidity that's going to continue to be pulled out of the system.
Yeah. You and I lived through those 70s, and I remember interest rates at 13%. So I 4 to 5% would be low on historical standards. 0 is ultra low, but 4 to 5 would be normal, wouldn't it?
I think, yeah, number one, I look back at inflation levels going back for decades, and we're in the middle of the pack to the lower end of it. It's really the rate of change that matters for a lot of these things, and people are feeling the pain of it, no doubt about it. If you had a floating rate mortgage, and now all of a sudden you have to refinance or be subjected to rising rates. I mean, that's very painful. So in the US, it's a little different because you probably know this better than I. I don't know if you ever owned a house when you lived in the US, but you get these 25-year mortgages and your rate's in there for 25 years. That doesn't happen here. So it will curtail moving around. The pain will not be as great, other than people who have to go out, do have to move, or do want to buy something.
You talk about pain, and I know you just got back from Europe. You spent Christmas in Europe, and I was in Europe in, say, the beginning of September. And we traveled around southern England at that time. We had been in Italy during the summertime. And in both places, I was seeing robust economy. I was seeing people flying. I was seeing help wanted ads. The trains and subways were packed. Are things slowing down? Was it your sense that things have slowed down a little bit?
No, not my personal experience. Now, I was there at Christmas time, and the markets were jammers. Prices were high, but people were spending. That was my sense. The UK is a bit of a different beast because I think they do have a lot of issues in terms of, we all saw the government issues that they faced in terms of the changes at the top, and but I think they have some big issues. But generally speaking, economic activity is pretty decent. I mean, the fourth quarter of 2022 for the U.S., for example, may come in at 3 or 4% growth. I don't get a sense that anything's really slowing down. You see it in the soft data. You see it in the ISM data where they do surveys. And somebody says, "Oh yeah, my business is slowing down." Well, you're not going to come out and say, "Yeah, it's great," when you see headlines all the time. Every time you open the paper, somebody's talking about something being awful, a recession on the horizon. So it's really hard. People are hard pressed to say, "Yeah, I'm bullish," in the face of all of that negative press. So the soft data is showing a turn down, but real data, not so much. It is showing up in inflation numbers. Used car prices have rolled over. New car prices have rolled over. Food has rolled over. But, there's still a lot of people employed, and there's still a lot of jobs out there for people who might end up losing their job.
Well, that's interesting you talk about that, because in the most recent earnings quarter, the tech companies in particular, but a lot of companies did the same thing. They had not great earnings, and they turned around and they cut their labor force, in some cases by tens of thousands. Will we, do you think, see more of that happening? The speed of response by the companies was amazing, but do you see more job cuts happening in response to earnings?
Yeah, well, I thought Bank of America put it the best. They're doing it they're not cutting. We've seen Goldman, we've seen Morgan Stanley. Bank of America, I think, said it best. They're going to let attrition, reduce their headcount. So they've frozen hiring. They've frozen, aspects of their headcount, but they're not cutting across the board. I had some number, Amazon's the poster child for some of this, and I was just looking at their head count. I mean, they have 1.5 million employees, Amazon does. During 2022, they added 427,300 new jobs.
Wow.
That's like 50%, kind of round numbers. They've only cut, I don't know, 10,000, 15,000. Now that's from corporate staff. They still have corporate staff of 300,000 people. I mean, there's going to be a lot more from Amazon. And I think the street would welcome it. I think it's fat and bloated. And I think the street would welcome that. And they'd probably welcome it from other companies in the tech space generally, because I think, there was a hiring craziness in 2020. So pulling back that craziness, fattening up some margins a little bit, getting through 2023, I think will be well received by the street, as long as there are other things going on as well. It's not just a one-trick pony when you're analyzing these companies.
I'm getting the sense that you're a little bit more constructive on the stock market.
I have been constructive. We're acting pretty well so far this year, still way early. I mean, there's a lot of history that suggests that this year could be very good. The third year of the presidential cycle, and people can talk about all about that stuff. Expectations are coming down. Earnings expectations have been trimmed. They'll probably continue to be trimmed. But as I always like to say, you trim them low enough, you can just step right over them. It's pretty easy to do that. There's a lot of, the technical setup is pretty attractive. If you look, the chartists, if you look at a ton of things, they're all bottoming. I mean, it's all quite nice. Of course, the world could end tomorrow and, I'll look like an idiot.
Don't say that, it might.
Well, that may be true. And there's lots of things that can go wrong for sure. But the first half earnings expectations aren't that great, but you start to see better earnings expectations in the second half. And quite honestly, markets should be looking ahead. I'm more constructive. I'm not, mortgage your house to buy stocks or anything, but I think there's a lot of opportunity. Yes.
Yeah, well, except that I read your blog just this morning, and it was one of your older blogs, a couple of days maybe, and you talk about copper, which copper's got the PhD in economics. It's the one you should watch. And you were looking at supply and demand equations in copper. Not such pretty signs.
Well, on the supply side, I mean, there are some good signs because visible copper inventories, that's what's tracked on the LME and various, obvious sites. Inventories are low, at not record lows, at the lowest seen for at least a decade.
Yeah, China. I was looking at the chart. It was tracking down.
That was pretty impressive.
Yeah.
And so, if China doesn't shut down again, I mean, the need for copper remains pretty great, and the supply isn't terrific. At $4 copper, companies make a lot of money. So in the end, that's what you have to look at. Who's going to be able to mine that copper, and who's going to make money at $4? Their costs are going up, of course, because in many places they're in jurisdictions where the governments want money, and also their own costs are going up, whether it's wages or energy prices. So it's not all sweet profits to the bottom line, but I like copper.
Okay, that's good to know. Any other areas that you liked as we finish up, especially in the Toronto Stock Exchange, in our concentration? We talked about it last year, concentration in energy stocks and in banks and that kind of stuff.
Well, energy was great last year, up 30% the TSX. It was great the year before. There is a lot of money. These companies are churning out a lot of money. Look at Imperial Oil, for example, which will probably be debt-free in about a year's time. And all of that excess capital, free cash flow, and these companies are yielding free cash flow yields are in the mid-teens. Um, I guess my only concern about energy is that, gee, everybody's kind of bullish on it. So I worry about that a little bit. Natural gas, nobody thought it was going to be, closer to $3 in January, which it is now, versus people thought it was going to 7 and 8 and 12. So you got to play your spots. So I do like oil service because I think ultimately companies are going to have to drill again. So I'm sort of more intrigued by that aspect. I have been liking gold, but it's had just a huge move here, and the stocks have had a huge move. They all look pretty spiky, so I'll pick my spots.
We made
Canadian
that call
banks,
last year when we were talking a year ago. You like gold then too, so it worked.
yeah, it went up and then it went down. So it's like all of these. So some of those things you do have to, unfortunately, aren't buy and hold. You have to be on your toes and trade them a little bit. Canadian banks, I think diversified financials will come back. They had a horrible year last year. Banks didn't have a great year. They were down 9%, but the diversified financials, the mutual funds, those kinds of companies were horrible last year. So I think there might be an opportunity in those. And even the life cos, I probably prefer the life cos to the banks because they've sort of hung around a little bit more than the banks have. They've held in, but I think they have some upside potential.
Okay,
And
now
I like
Francis,
industrials here. Oh, sorry.
oh,
And industrials. I think you got to own at least one industrial in this country because they are cheap, cheap, cheap.
okay. So I know you're right about this stuff, and I promoted that you have a blog, but can anybody get your blog?
Absolutely.
Okay.
You go to francishorodelski.com and scroll down to the bottom of any blog, and you can put your email address in. You will get a follow-up email saying confirm, and then the next day you will receive it. And it's totally free. It'll always be totally free.
And it's always good reading. Thank you, Francis.
Thank you very much, Pat.
See you soon.
You too.